Hey, what's up, guys? It's a beautiful day for investing and we're diving into the exhilarating world of the stock market. So, buckle up because we're about to unravel the mystery behind finding solid, gold standard stocks. Let's go! The stock market is like a vast ocean filled with an array of different fish. But which one should you go for? The answer lies in a deep understanding of the company you plan to invest in. Let's get to know our potential investment fish a little better. Imagine a company as a living organism. You need to know what it feeds on, how it thrives, what it's made of, its strengths and weaknesses, and most importantly, its unique characteristics that make it stand out in the crowd. You should be familiar with the company's business model, its competition, financial strength, and the products or services it offers. When you can understand the company well, you're more likely to make smart investment decisions. Let's put it this way, would you buy a car without understanding its specs? Definitely not. So, why should investing be any different? Now that we've got a feel for the company, let's dive into some more complex stuff, the financial analysis. Picture yourself as a detective trying to decode the company's financial health. You want to know about the company's revenues, net income, cash flow, debt. You're looking for clues in the form of financial ratios like the price-to-earnings ratio, debt-to-equity ratio, return on equity, and current ratio. These numbers tell you a story. The better the story, the better the stock is likely to be. Still with me? Great. Because now we're going to talk about something super important: growth prospects. We all love a good growth story, right? And companies with solid growth prospects tend to make pretty appealing investments. Look at the company's track record. Has it been growing consistently over the years? What are its future projections? Just remember, though, past performance doesn't guarantee future results, but it does give us a bit of an idea. Here's another interesting angle to look at: dividends. Companies with consistent and growing dividends are like that reliable friend who always shows up when you need them. Even in market downturns, they provide a steady income stream. Key points to look at here are the company's dividend yield and payout ratio. But remember, you need to ensure that these dividends are sustainable in the long run. Now, let's step back and look at the bigger picture. What's the industry landscape like? Is it on an upward trend? Are there disruptions that could impact it? It's like understanding the ecosystem in which your fish is swimming. You don't want to catch a fish from a pond that's about to dry up, right? Alright, time to meet the team leading the ship, the company's management. They're the captains navigating through storms and steering towards growth. They should have a proven track record, strategic vision, and more importantly, they should be trustworthy. After all, you wouldn't want to be on a ship where the captain doesn't know what they're doing. Now here's something crucial. Just because a company is in good shape doesn't automatically mean its stock is worth buying. You need to figure out if the stock is over or undervalued. It's like shopping for a car, you want to make sure you're getting your money's worth. If you pay too much, you might never recoup your investment. So, use tools like the discounted cash flow analysis or relative valuation methods to figure out the stock's intrinsic value. Ever wish you had a crystal ball to predict how a stock would perform? Well, analyst ratings are the next best thing. While not foolproof, these ratings do offer a glimpse into what the market thinks about a particular stock. But remember, these are just starting points. It's always best to do your homework and not solely rely on these ratings. Alright, we're almost at the end of this exciting journey. Let's talk about the economy. The state of the economy can significantly impact a company's performance. Look at indicators like the GDP growth rate, inflation rate, unemployment rate, and consumer sentiment. Think of these like the weather conditions in our fish analogy. Bad weather can make even the strongest fish struggle. Finally, and this is super important, remember to consider your own risk tolerance and investment horizon. It's like deciding whether you want to swim in the shallow or deep end of the pool. If you're afraid of the deep end, stick to the shallows with safer investments. If you're okay with a little risk, dive into the deep end, but remember to always have a safety plan. That's it for today, guys. Remember, when it comes to investing, knowledge is your superpower, and patience is your shield. It's a marathon, not a sprint. Diversify your portfolio, spread out the risk, and most importantly, keep learning. As always, take these tips as a starting point. Do your research and consider consulting a financial advisor before making an investment decision. I hope you found this video helpful. If you did, smash that like button and don't forget to subscribe for more awesome content. Until next time, happy investing!